As the U.S. stock market is currently closed, Nuburu, trading under the ticker symbol BRU, finished yesterday's session on October 14, 2025, at a price of $0.18 per share, marking a slight downtick of 1.2% for the day. Now, the common perception paints this as just another micro-cap stock caught in the undertow of market volatility, a footnote in a portfolio otherwise focused on titans like Apple stock or Nvidia stock. The expectation is that its low price and recent performance are indicative of a failing enterprise. However, the reality hidden within its trading patterns and its niche technological focus suggests something different is at play. The real story isn't about its daily price fluctuation, it's about the silent, high-stakes industrial race for manufacturing efficiency, particularly in the electric vehicle and battery space, where Nuburu's core technology is not just an improvement but a potential necessity. Most investors looking at BRU through their Fidelity or Schwab Intelligent Portfolios accounts see a stock that has been battered since its public debut. The narrative is one of disappointment, a tale of a special-purpose acquisition company that failed to live up to its initial hype. This is the prevailing expectation, a high-risk, low-priced asset best left to day traders on platforms like Robinhood who are chasing short-term momentum. But this perspective misses the fundamental disconnect between the stock's market valuation and the industrial problem its technology addresses. The deeper reality is that major manufacturers are confronting a physics problem. Welding copper with traditional infrared lasers is incredibly difficult due to copper's high reflectivity. This is a significant bottleneck in producing EV battery packs, power electronics, and other advanced components. Nuburu's blue laser technology, by its very nature, is absorbed far more effectively by copper, leading to stronger, more reliable welds with fewer defects. So while the market sees a struggling stock, engineers at major automotive and electronics firms see a potential solution to a multi-billion-dollar manufacturing headache. This is where expectation and reality diverge sharply. Examining the recent trading activity, we see volume that is often sporadic, typical for a stock of this size. On days with no news, trading volume can be thin, allowing for amplified price swings on relatively small orders. However, we've observed periodic spikes in volume that don't always correspond with a press release. This can be an indicator of quiet accumulation by investors who are looking beyond the daily chart, perhaps conducting their own due diligence on the technology's application. Many retail investors using a SoFi Invest or Robinhood app might be shaken out by a 5% drop, but a closer look at the order book during these volume spikes could reveal larger block trades being filled. This is a critical detail. Is it institutional funds taking a small speculative position, or is it a strategic investor? While many are focused on the price, the smart analysis focuses on the character of the volume. We are not seeing the consistent high-volume retail frenzy that characterized meme stocks. Instead, it's a pattern of quiet periods punctuated by sharp, focused interest. When you compare this to the constant churn of a mega-cap like Tesla stock, you realize the players involved in BRU are likely fewer but perhaps more informed about the specific industrial sector it serves. The company's business model is straightforward. It designs and manufactures high-power blue laser systems for industrial clients. Its primary targets are in e-mobility, consumer electronics, and 3D printing. The expectation is that a company like this should be announcing major partnerships with top-tier automotive giants every quarter. The reality is that the sales cycle for this kind of specialized industrial equipment is incredibly long and complex. It involves extensive testing, validation, and integration into existing assembly lines. A potential customer doesn't simply buy a laser, they invest in a new manufacturing process. Therefore, the lack of flashy headline announcements isn't necessarily a sign of failure. It's more likely a reflection of the methodical, behind-the-scenes work required to secure long-term contracts. The real catalysts to watch for are not speculative rumors, but tangible reports of pilot programs concluding successfully or orders for multiple units from a single unnamed client, which often precedes a larger public announcement. This kind of nuanced understanding is what separates a surface-level online investing from a deeply researched position. Platforms like interactive brokers with their advanced tools allow investors to monitor for such subtle shifts in trading and ownership data. Financially, the company is in a precarious position that feeds the negative expectations. Like many hardware technology firms in the growth phase, it is burning through cash. Revenue exists but has not yet reached a scale to support operations, leading to a reliance on capital markets to fund development and commercialization. This is the biggest risk and the most valid part of the bearish thesis. The market expects continued dilution as the company will likely need to raise more capital, putting downward pressure on the stock price. The reality, however, is that the value of the company is not in its current balance sheet, but in its intellectual property and its head start in a critical technological niche. The question is whether it can achieve commercial scale before its financial runway ends. This is the central tension of the Nuburu story. It's a race against time. An investor managing their own portfolio, perhaps through Fidelity Wealth Management or as a self-investing individual, must weigh the very risk of financial distress against the potential of the technology being adopted by a major industry. Comment below with your thoughts on whether you believe advanced manufacturing technologies like this can secure funding in the current economic climate. Looking toward the future, several scenarios could unfold. The bearish scenario is straightforward. The company fails to secure major contracts, its cash reserves dwindle, and it is forced to dilute shareholders significantly or face insolvency. This would confirm the market's current low expectations. The bullish scenario presents a starkly different outcome. A single significant contract with a major automotive OEM or a battery manufacturer could completely alter the narrative. Such a deal would not only provide a substantial revenue stream, but would also serve as a powerful validation of the technology, likely triggering a rapid reevaluation of the company's prospects by the wider market. This is the binary nature of the investment. Another potential catalyst is a strategic partnership or even an acquisition. A larger industrial laser company or a major manufacturing conglomerate could see Nuburu's technology as a valuable addition to its portfolio, providing a quick exit for current shareholders. This is not just speculation. In the world of industrial technology, acquiring unique capabilities is often more efficient than developing them in-house. Investors using various investing sites to track M&A activity should keep Nuburu on their radar for this very reason. The risk is high, but the asymmetry of the potential outcome is precisely what attracts those looking for opportunities outside of mainstream Fidelity ETFs or Fidelity mutual funds. In summary, the story of Nuburu is a classic case of market expectation clashing with technological reality. The market sees a struggling microcap stock with a challenging financial profile. The expectation is for continued underperformance. The reality is a company holding a potentially vital piece of technology for one of the world's most important industrial transitions, the shift to electric vehicles and advanced electronics. The gap between its current market capitalization and the potential size of the problem it solves is immense. The analysis of its trading volume, understanding its long sales cycle, and acknowledging the binary risk-reward profile provides a much deeper perspective than a simple glance at a stock chart on a Fidelity mobile app or Robinhood stock trading. The ultimate outcome will depend on execution and financing, but to dismiss it based on its stock price alone is to ignore the underlying industrial dynamics at play. The real measure of success won't be next week's stock price, but whether blue lasers become a standard feature on factory floors around the world. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up. Don't forget to like, comment, and share this video to support the channel. Hearts up.